Well, hey there, everyone. Welcome to Chart This with Dave Keller. Happy Monday. It's September 8th, 2025. We're coming to you from a beautiful late summer day here in Redmond, Washington. Temperatures are cool. I worked from the back porch this morning. That's a good thing. It is great to be back with you here in the home office. Hope you guys are all doing well. Hope you had a great weekend. We had a good weekend here with some decent weather, some good soccer. Watched my Ohio State Buckeyes drop 70 points on another team. Worst ways I've spent a weekend for sure. Kind of a sleepy, quiet day in the markets today, as you're going to see here. There was some movement sort of underneath the hood, particularly outside of the equity space, right? We look at the commodities market, we looked at the fixed income markets, quite a bit of movement. Currency markets with the dollar shifting lower here over the last week. Equity is sort of like the quiet part of the markets here today, but the benefits of technical analysis, or one of the great benefits, is that it is pretty much it's applicable to any market, right? As long as the data is available and consistent and plentiful, and it's a liquid market, you can apply the lessons of technical analysis. You can apply the toolkit to understand price and trend and momentum. So we will do our best to address that on all the different markets. I was a minute late today because I was looking at the preview of the Apple event coming up tomorrow. I did grab the chart of Apple. A lot riding on an event like we're going to see tomorrow with potential or certainly expected new line in the iPhone for iPhones with an iPhone 17 line, new iPads, new little of everything, new AirPods, watch models. I mean, all of these things. So the question is going to be, what's the reaction from a technical perspective? What's interesting is the chart of Apple arguably looks better than anything in the Magnificent Seven space. You have Alphabet that's gapped higher, but it feels very extended now. Apple just feels like this nice kind of classic breakout with clear risk versus reward on the chart. Not a bad setup here, but again, all rides on what we hear tomorrow. With that in mind, if you're new to the show, welcome. I see some people putting some comments and questions in on our live stream. We are live streaming on Facebook, LinkedIn, YouTube, and X. Appreciate you so much tuning in live. If you're doing so, you are welcome to ask questions all during the show. At the end, I'll take a question or two before we wrap for the afternoon. If you're watching this later on our YouTube channel, always open to your questions. Just drop a comment below the video with your question. We did an all mailbag episode on Friday with some really great questions from all of you just in the last week. So please keep them coming. Keeps the content interesting, gives me some great ideas of things to cover, and certainly helps me focus the content on what's going to be most helpful for all of you. Here's what the market looked like for the equity space. The S&P did push above 6,500 briefly, kind of late morning Eastern time. It did rotate back lower to make an intraday low around 6,485. By the end of the day, kind of middle of that range, slightly below 6,500. We'll call it 6,495 and change. That's up just less than 0.25% from yesterday's close. The Dow up about 0.25% as well. The NASDAQ about double that percentage move, about 0.5% higher. So again, not a huge movement day all around. All of these major indexes, were kind of range bound through the course of the day. Looking at the mid cap and small cap indexes, both ended up slightly in the red. The VIX essentially unchanged from Friday. We'll call this a very low volatility environment. Below 16 is pretty much as low as you're going to get. I mean, the VIX has randomly and very, very rarely gone into single digits, but it's incredibly rare. A VIX down in the mid-low teens is about as low as you're going to see the VIX. So what that means is low VIX means low volatility. That means low fear. That means low uncertainty. That means the options market are telling you conditions are pretty good for stocks right about now. Looking elsewhere, I mentioned some of the movement in other asset classes. This is where the show could get a little more interesting from a price movement standpoint. Bonds continue to rally here. So while stocks are sort of treading water, bonds are starting to rally. The TLT was up another 1.3% today. 10-year yields pushing lower. So we're down not quite to 4%. We're around 4.05 at the end of the trading day today, but getting very close to 4%, which is a level we've not seen in quite some time. I mean, I think 4.2% was sort of that lower end from a technical perspective, clear area of support. That's now broken to the downside. The TLT bond prices breaking to the upside. The treasury markets have been essentially sideways here, but now you're seeing sort of renewed expectations with the latest inflation data, with the latest jobs data, sort of assuming that we're going to get probably 3 rate cuts with the remaining meetings here in the for the Fed in 2025. It's essentially what the market's pricing in with rates coming down like this. Dollar down about 1/3% as well. Looking at the commodity space, further new all-time highs for gold and silver. The GLD finished about 1% higher, which means spot gold continuing after yesterday's push to new all-time highs, continuing that uptrend here today. And I do have a position in GLD, as I've often mentioned. Crude oil prices bouncing a bit, although the chart of crude oil is not particularly great. Sort of a nice move, a counter trend move, I would say, higher today. But weaker dollar, weaker crude oil, stronger gold. That's been the general way I've thought of currencies and commodities here recently. Bitcoin sort of hit around 110,000 in the last 24 hours, rallying a bit here as we go live with our show, around 112,000. Ether price is slightly lower. It's still around 4,300. Ethereum has been outperforming Bitcoin. That's been the general trend here, which has tended to continue. I did grab the chart of Bitcoin just to show you the setup here. And actually, it's a very interesting setup, similar to what we saw, which you could say we've seen here with Apple, right? Which is a sort of a breakout and then a pullback to an established level of support. And what Apple's done is actually just rotate higher beautifully. It's what you'd want to see Apple to do, sort of continue that bounce off of bouts of support. We'll see what happens here, but we'll show you the chart and what levels are most important to us. All right, looking at the 11 S&P sectors, you can see growth at the top of the list, particularly technology, the XLK up 0.8%, consumer discretionary, the XLY number 2, up 0.4%, industrials third from the top, excuse me, up about 0.25% here, about a half and half, right, between sectors up or down for the day here. On the downside, it's the defensive sectors, utilities down 1%, real estate down about 0.2%, consumer staples down about 0.33%. We had our monthly chart review for our market misbehavior premium members. It is always an awesome time to become a premium member if you're so moved, if you like what we're doing on the show, and you'd love more virtual courses, more education, and more reports that I save for my premium members, as well as our member-only community. You can sign up at marketmisbehavior.com/premium. Don't forget to use the code YouTube when you check out for 30% off your first 12 months on any of those plans. We talked in the monthly chart review, particularly about utilities and the underperformance of utilities. Utilities trading less like a defensive sector recently, more like a growth sector, right? And it's sort of tracked the movement in semiconductors. There's a sort of high correlation between AI and AI-related names and utilities providing all the electricity to fund or to fuel all of that awesome computing power that is being leveraged with generative AI. For today, a bit of a change from that, with technology up about 0.8% and utilities down. But the relative strength in utilities has not been particularly good here recently. All right, looking at the breadth data, kind of a neutral day, I would say, overall. You can see small caps a little more negative with only 39% advancers. But if you look at the New York Composite Index, even the NASDAQ Composite, the S&P, almost a 50-50 split between stocks up or down. So it really was kind of a flat day for the averages, kind of a flat day in terms of breadth. Really feels like the market is holding its breath, as it were, for the big Apple event tomorrow. That's the big kind of Magnificent Seven event happening this week. Not a lot of earnings, a couple of tech names to look at, but not a ton. I mean, it's not a big earnings period until a couple weeks out here. You go to early October, that's when we'll get the next big run of quarterly earnings. There'll be some consumer and random stuff between now and then. But this week, Apple tomorrow, and then inflation data with CPI and PPI coming out Wednesday and Thursday. Before kind of some big announcements like that, it's not unusual for the market to sort of hold its gains, tread water. That's certainly what it felt like today. Our market trend model remains bullish on all time frames, particularly for the S&P 500. So my toolkit is saying kind of risk on, innocent until proven guilty. And I'm seeing signs that tell me we could be near a top, but no actual price reversals, which would be confirming any sort of top at the high level just yet. Keep watching the show. We'll certainly do our best to keep you informed along those lines. All right, looking at the Magnificent Seven and Friends, these leading growth names, you can see Broadcom recovering a bit after last week. We had the gap higher on earnings, but then it opened and then closed down toward the lows of the day. It's kind of an underwhelming, anticlimactic resolution to that positive earnings win. But today, regaining some of that lost action on Friday's session, up about 3.25%. Amazon up another 1.5%. That's helping the consumer sector do just fine today. Nvidia and Microsoft both having some decent updates after breaking below their 50-day moving averages last week. On the downside, Tesla down about 1.3%, still kind of holding in after that coil pattern that resolved to the upside. Apple down about 0.75%. Alphabet down about 1/3%. I think that's it for the first page. Let's continue on and look at the heat map. As a reminder, I can see questions that are coming in on all the platforms. Keep your questions coming. We'll grab a question or two at the end of the episode. Any of the questions we don't get to, we will put into our mailbag. I had an all mailbag episode on Friday. By the way, latest episode on the Market Misbehavior podcast also went out actually just early this morning, now that I think about it. Had a really fun discussion with Larry Tentarelli. Larry's the editor of the Blue Chip Daily Trend Report. He's a fantastic stock picker, a great technical analyst. And we had a great time talking about going from randomness to routines, which is what I ended up kind of titling the episode, because he talked about the importance of routines, which is so important to me if you followed my work, because we talk a lot about daily, weekly, monthly routines, how important they are. And why consistency matters in your analytical process. And Larry had some great examples of how he learned those painful lessons of having more random approaches versus having a set of well-established routines. Talked about finding good breakout ideas, the benefits of trend following, lots of great market perspective, talking about different charts. So you can check that out on our YouTube channel and also on all the podcasting platforms. We're on all of them pretty much at this point. All right, continuing on here with the heat map. So what stands out to me? So I tell you what stands out to me. Number one would be strength in technology, right? You see Broadcom, IBM, Oracle, ServiceNow, Uber, Adobe, Cadence. These are all up 2+%. And that's helping the technology sector be at the top of the list. Apple's sort of an outlier, certainly in the top 10 stocks in the XLK, actually down today going into tomorrow's announcement. Of course, and again, the trend in Apple is still fine. You'll see that on the chart here, but trading off a bit as investors wait with bated breath for tomorrow's product line updates. Other things that I'm noticing is if you cover up technology literally with your hand and you look at the rest of the heat map, not great. Sort of a kind of okay to not so okay, depending on what sector you're looking at. I'm particularly noting communication services. Now, the three biggest names, Alphabet, Meta, and Netflix, kind of the big growthy part of communication services, all kind of flat to slightly lower. But the real pain here is in the old school telecoms, mobile companies, AT&T, Verizon, T-Mobile, all down a bit here. And those aren't horrible charts, right? AT&T actually made a new all-time high last week. But the reversal is concerning, right? So something like T-Mobile has been a chart we've talked about because, kind of this nice rotation higher. We went from a pattern of lower lows and lower highs to higher highs and higher lows. And just as of Friday, we're finally getting the moving averages back to the proper order with the price above the 21-day EMA, the 21-day above the 50-day, the 50-day above the 200-day, kind of just got back there. And then we have the gap lower today. It did hold, if you note, the 50-day and 200-day moving averages, kind of a confluence of support right around 240, 242. That did hold going into the close. But I think a break below 240 really completes a downside rotation, which would be a frustrating end to this, what ended up being a really promising rally off of a mid-June low. So again, charts like this, I think, are constructive charts as long as they continue that trend of higher highs and higher lows. Today, with the gap lower, starting to change that configuration, at least on the tactical time frame. This is when I like to think about moving averages as potential support levels. We break below the 200-day. This kind of chart I'd probably be avoiding until we get back above the 200-day, right? That's sort of the sign that things are starting to recover. So T-Mobile and the rest of telecoms, the old school telecoms at least, kind of weakening off here a bit. Financials kind of okay to decent, and you can see some of these names kind of rallying a bit but not much. I mean, these are not impressive, bounces just yet. The financial sector overall has been remarkably strong. Larry Tentarelli and I talked about banks, regional banks, some of the areas of the market that have been doing quite well here. And I think if you're all bulled up and you're looking for sustained gains beyond what we've seen off of the April low, given the weakness, I think we clearly have seen in the AI trade, in semiconductors, and those kind of previous leadership names, really looking for like financials, healthcare, maybe like industrials starting to resume the uptrend and show some new strength. I think the absence of participation there could be a problem. Last thing I would say on the heat map is just the again, underperformance of utilities. I've often thought of utilities as kind of my favorite defensive sector. As a matter of fact, one of the key ratios I've looked at for years is the relative performance of the S&P to the XLU, right? So looking at the S&P 500 versus the utility sector. And if utilities are underperforming, that's usually good for risk assets. If utilities are outperforming, that's generally bad, only because utilities are a fairly defensive sector. That's kind of been changed. That script has been edited aggressively as utilities are becoming, the fuel to light up this growth engine of AI and just the incredible, energy requirements here. So utilities selling off doesn't make me feel great at this point. It's almost like the opposite of the normal takeaway I see with utilities lower. But for today, at least, moving down with some of the defensive sectors like consumer staples and REITs. So maybe it's back to its roots as more of a defensive play. All right, let's continue on here and look at some charts. I did hand select some charts. This starts with my morning coffee routine, which is the set of charts I look at every morning. And then I kind of build to this list through the course of the day as I'm going through and analyzing different charts for different purposes, and try to identify some key ones to share with you that I think tell a compelling story about what we observed in the market today. From a high level, I mean, not much of a change here. This is what you call an inside day. If you're thinking of bar chart analysis, we talk a lot randomly about candlestick analysis, but bar charts on their own, you don't have to use candles to be, to understand the short-term dynamics, how days incremental new information of each trading day kind of helps you make sense of things. This is an inside day, which really does represent indecision, right? Think of it like a doji candle on candle charts. When you have a big day and then the range just kind of comes in, days 2 range is completely engulfed by day 1's range. It just kind of means lower volatility from day 1 to day 2. It really is kind of a holding pattern, a placeholder. No real change to the trend, but not kind of the upside follow through, right? So, I mean, in a bullish market like this, you need big upswings with stronger momentum, ideally stronger volume. We can track that by looking at things like RSI. Is the price moving higher on stronger RSI readings? It is not, as you can probably see from the chart in front of you. We can also talk about volumes, things like the Chaikin money flow, remarkably strong still, right? Telling you that the volume is fine. We're not seeing any big sell-off days, big distribution days that should get you concerned, according to that methodology. So this really was kind of a, just kind of a wait and see mode as we brace for the additional news with, the latest jobs data, inflation data, Apple. That's the 1, 2, 3 punch, I think, to be ready for, barring some other thing we don't know about yet. Those are the 3 things kind of on the schedule that stand out to me. Breadth, to be honest with you, I mean, it's kind of underwhelming, right? I mean, as we've made new all-time highs in July and new all-time highs in August, and now so far in September, the S&P making a new all-time closing high yet again, closing briefly above 6,500, right at that level. All of those new highs in July and August have been driven by less stocks above their 50-day moving average, less momentum in the form of lower RSI. And I think that is the kind of big red flag that I'm seeing here that has changed from June and July to now August and early September. If you think about what's different, right? What are signs that this bull market is more in a mature period in the 8th or 9th inning or so? Weaker breadth, weaker momentum are two of the key bullet points on my market top checklist. And I think both of those are kind of flaring up right now. So stocks above their 50-day moving average up around 80% at the end of June, currently around 61%. Now that's not a horrible reading, right? That's not like 30%, which tells you everything's breaking down. Get out of the way. it's just not kind of, as strong as you'd want to see, right? It doesn't give me sustained advance buys. I mean, the most bullish thing you would see would be this, line starting to rotate higher, which would tell you stocks that have been weighing on this market are now starting to participate. We're not really getting that yet. Long-term breadth, which is the percent of stocks above their 200-day moving average, still very much in a safe bullish reading. The S&P itself is very far off of its 500 points plus off of its 200-day moving average. So we'd have to have a significant drop. It's what, 8% drop to get down to the 200-day moving average. That's not a small move, right? That would be a significant drop to get there, and that could happen. But at this point, it's telling you most stocks are also above their 200-day moving average. So, what I would really get concerned about, this is just sort of an underwhelming bull market kind of reading. When these start rotating lower, even if the S&P still remains kind of strong, that's where I would be. That's where I would be kind of concerned. All right, bond prices, a lot of movement here. And again, as I mentioned, equity markets kind of treading water. Themes we've been talking about in recent weeks still very much there. Bonds are where there's a lot of movement here. And this is tied, obviously, of course, to the Fed meeting, the September meeting coming up here next week. Market basically pricing in a 25 basis point cut. Market also pricing in additional cuts at the subsequent meetings to finish off 2025. As a result, rates are coming down, particularly the short end of the curve, like the 2-year end coming down, the 10-year point coming down, and bond prices, we're looking at the TLT here, starting to spike up here. So this is basically, what you have to realize. This is sort of economic data kind of showing slowing growth, slowing economy, kind of giving the Fed all the information that investors think they need to start cutting rates again. As a result, rates further out in the curve are starting to come down here, and bond prices are starting to rally. A lot of people have been ignoring bonds as a place to be, and I don't blame you, because it's not been a particularly great chart. It's really been more sideways than anything. We've been talking about this general uptrend. I think this last week is just sort of continuing the uptrend phase that we've been talking about. From June into July, you saw a really change in momentum as the RSI went from a clear bearish range to much more of a bullish range. I think this latest upswing just kind of confirms that bonds are in a primary uptrend until proven otherwise. Higher highs, higher lows. What's happening now is with bonds, rallying and stocks basically sort of holding steady. That means the stock to bond ratio is rotating more in favor of bonds. Now, the general trend in this ratio has been up, certainly since the April low. If you look at, this year so far, stocks outperformed bonds in the fourth quarter of last year, really into mid-January. One of the really telling parts of the February peak was that the stock to bond ratio was actually already starting to make a lower high as the S&P was making a new high. And that suggested a bit of a downside rotation, which certainly accelerated into an April low. The ratio has been generally moving higher here. Now, we did get a dip in this ratio at the end of July, kind of coincided with the S&P rotating lower. I just have a little chart of the S&P at the bottom just to remind us what was happening during these periods. So, big drops in the stock to bond ratio, obviously usually mean sort of a risk off move, and the idea that investors are going to some relative safety in the bond markets. Let's keep an eye on this one because, again, generally the longer term trend has certainly been stocks over bonds for many, many years. But some big pullbacks in this ratio have coincided with major sell-offs in equities over the last couple of years. So for now, this last week, really making that ratio turn lower. Here's the chart of Bitcoin that I just wanted to walk through with you. And again, there's a bit of what we'd call polarity, which is this technical concept where resistance becomes support or support becomes resistance, right? It's the sort of the part of the technical toolkit that talks about prices having importance and having value in certain markets. Certain price levels resonate with the market for whatever reason. And this idea of polarity is just recognizing that when you see a major resistance level, it's often really good to pay attention to that because it will often turn into a support level down the road. And we're starting to see that, I think, in the chart of Bitcoin. So we have the peak in December of 24, the peak in January of 24. These are both kind of in the 105 to 108 range. Both of these basically up at 108,000. And then we can see that was where the bull trend off of the April low. So stocks and Bitcoin both bottomed out, right at the beginning of April, rotated higher. Bitcoin actually pulled back a bit in May and June, and it stalled out, sort of an attempt to get above those December and January highs. We finally did break above there, and now we're testing that level. So classic technical setup is you have a breakout above a significant resistance level. That resistance now becomes support. That ends up being sort of the springboard for the next big leg higher. So I think Bitcoin pushing off of that kind of 107,000 level, sort of in this shaded area that I've shown to sort of relate this to the previous highs. Also a key Fibonacci level around 105. It's all kind of right in this range, so it makes sense that that's where we would find some support. Now we're getting an initial move higher. So, definitely people have been thinking about the downside of Bitcoin during this period as it's gone from 125 down to 107. But now, as long as that support holds, I think this is still a pretty constructive chart. Now, the other side of this is we break below 105,000. I think all bets are off. And I think this turns into a very disturbing chart very, very, very quickly. And you can see the RSI as well. It's held 40 on all of these pullbacks. So I think we're right at that kind of that key point. As a swing trader, I get the argument of betting a swing back to retest those previous peaks. That would actually make sense based on this structure. And I do still have a decent position in Bitcoin and Bitcoin ETFs. We break below 105,000. That's where I have an alert set. That's where I'd start to question that overweight and certainly start to most likely start to take some off the table. For now, I think okay, as long as it holds support. Now, Apple down a bit, right? Down about 0.75%. Tomorrow, big announcement. I think it's at 10 a.m. my time, 10 a.m. Pacific, 1 p.m. Eastern, I'm pretty sure. Always interesting it's such a fantastic production. It really is, in terms of the audio visual experience and what they try to convey. I find that part really interesting. But there have been times when there have been Apple product announcements and it's sort of like a yawner, and you're reading kind of the previews and you're like, boy, this doesn't feel like it's going to be that helpful. This is a big product announcement. And if you think about what would cause the chart of Apple to keep going beyond what we've seen so far, you need a lot of people like me that have a working iPhone that we're pretty happy with, wanting to spend a lot more money to buy a brand new one. I don't know if I'm there yet personally, but other people are sort of a different part of their, phone refresh cycle. But that's what, iPhones are still a huge part of the revenue. They're going to talk about other things like the watch and health and AirPods and iPads and all these other things, which are all pretty awesome too. But it really is driven by, the iPhone and getting people to continue to refresh with a very expensive piece of hardware that you carry around with you. So we'll see. I think that's obviously important to follow. From a technical perspective, 225, just a really important pivot point. And this is why the chart of Bitcoin and Apple are kind of very similar right now, because Apple also broke above a key, pivot point, as we would call it, or a level of polarity, right around 225. That's the 61.8% retracement back up to the December 24 all-time high. We're taking that off of the April 25 low, which was down around 168, 169. So 38.2% was where that first sort of up thrust stalled out. We can see then we finally broke above the 61.8% level, pulled right back to it here in late August, and now we've resumed this uptrend. So I think this chart above 225 is a great chart. That's a good chart. What concerns me right now with this last gap higher on weaker momentum, slightly. Not a huge divergence, but a little one. But again, as a trend follower, I'm kind of watching that 225 level. We see a break below there. People are really not impressed with what they see in here tomorrow. That's where I think a lot of stops would kind of logically be. And what that means is a break below there could cause quite a bit of pain for Apple shareholders. All right, just to finish off, I want to talk about healthcare. Healthcare is one of those sectors. Again, it's like people have loved to forget about it because it's been a nothing burger, right, for much of 2025, particularly off the April market low. Look at what the XLV has done since April 7th, April 8th. The S&P and the NASDAQ have kind of done this, and healthcare managed to make a couple lower lows than that April low. Basically, that's become the floor around 128 to 129. We've had a couple bounces off there. So as a trader, thinking of that lower end of the range as just an ideal entry point makes a ton of sense to me. The question is, do we have sustained gains beyond this rally higher? On a short-term level, that 136-ish level is pretty interesting. That's kind of where the top in June, July was. We've now kind of broken slightly above there. We're holding, so we're kind of in a limbo below the 200-day moving average around 138, above the 21-day EMA and the previous resistance around 136. We're right between the 50 and 200-day moving averages. The XLV feels like it's sort of waiting for the break, and I think a break to the upside could be obviously pretty encouraging, particularly in a sector that's been such a chronic underperformer. Outperformed a bit in August because it's gapped higher. Stocks like United Health, and there's so many others in the healthcare space. We don't have time to go through all of them, but like look at the chart of UNH. I had an alert set for when it broke 320, and it triggered this morning. This is why I love setting price alerts. I do it on the stock charts platform. A lot of platforms have that alert capability. I would say as a technical analyst, huge life win to be able to have a platform watch key levels. You analyze the chart, identify key levels, then have a computer watch it for you and then tell you when it's triggered. I mean, it's just a much better way to live than, continuously checking a chart to see if a break has occurred. And so for me, the alert hit, so I checked it out. It's not quite enough here, and it's a bit of what we call a hanging man candle today, which isn't great, but we're stalling out right at resistance at 320. That was that swing high off of the gap lower in May. That's where we retested in early July. It's pretty much where we stalled out in mid-August, and that's where we are today. So when you've had this kind of basing pattern, this rectangular pattern, a break above 320, significant, right? Because what that means is there's something new, right? There's a change of character. People are finally willing to pay more than $320 a share, which they have not been willing to do since the complete, waterfall decline in April and May. So is this stock finding its footing, and are buyers really starting to come in force? And I think a break above 320 would certainly validate that. So right at that point, I think it's not quite there from how I tend to analyze the chart, but certainly something to watch. And there are a bunch of healthcare names kind of like that. I would encourage you to be scanning for ideas in the healthcare space. I'm kind of finding more and more as I spend my own time digging through some of the scans. All right, we'll take a question or two, and then we'll be done. All right, let's see. Today we did talk about. I had a couple questions about Apple. I think I covered that as much as I kind of really want to at this point. So we'll see what happens. Tony, thanks so much as always for watching the show and for asking great questions all along the way. Do you ever use the candle glance? This is on stock charts for your portfolios or watch lists. Yeah. So, what's funny is I only kind of show a portion of my own toolkit on this show and on other things. With my premium members, they see a little bit more about what I do, because a lot of the reports and stuff that I create and videos that I turn out only for my premium members come from my own sort of regular, like monthly review. I do a certain set of things. And, when I'm going through the charts in the morning, I actually go through a lot of them like this. This is the intermarket analysis watch list that I have. And I start with what's called the candle glance view. The candle glance view, basically what it does, it's a throwback to an old school style of charting that I used to do in my Fidelity days. We printed out an outrageous number of charts every day. Again, I feel like that was my kill trees. Part of my career was printing out. I mean, we each had a printer in our office because we used them so much. We would print everything out, and I'd draw on them with pencil or with pen and circle things, and we'd share them with each other. We did it all manually because that's just what we did. And so we would print out, if you're looking at a group of ETFs or a portfolio or a sector, you'd print out all the stocks, and then you start going through them, and you'd start putting them in good, bad, and okay piles. And then you go through the good pile and kind of separate them from the really awesome to the kind of good, and to go through the bad from the absolute disasters to the, kind of breaking down. And you kind of further go through there. And then depending on what someone was trying to do, if we're trying to focus on areas of risk, we kind of go through some of those things that are just starting to rotate, particularly in a portfolio. It's like anything in that bucket, we'd want to go through with the portfolio manager, kind of review, hey, look, these are things that you've owned that have done very well that are now no longer good. And that stuck with me, still the way that I think of it today, of course, in my own process. But this is kind of the electronic version of what we would do by throwing a bunch of charts on a big conference room table and then just starting to see what patterns looked similar to one another. We had a set of charts in the Fidelity chart room that had they weren't this small. They were actually on a huge wall, but it was the top 50 top 50 stocks listed in the US, if I remember right, by market cap. And I used to love looking at that wall and just thinking about what looks similar. And this is where you would see, okay, out of the Magnificent Seven, these two stocks look really good. These two stocks are breaking down. These are the ones that are kind of actionable, and it would help you understand that. So this, what's called a candle glance view, I think is a fantastic way of taking a group of anything and kind of making sense of them. And I do that there. I do that with global ETFs as just a way of glancing through and just seeing which ETFs are breaking out to new 52-week highs, which ones are kind of stalled out and not quite doing that, which ones look very different, like India, right? You can see when you're looking at the global ETFs, look at how India is unique, right? None of the other charts kind of look like India, maybe Germany a little bit, but India is the only one that's kind of right back at its 200-day moving average. The rest of these are obviously way more elevated. So, in terms of recognizing outliers and what looks different, I find this visualization fantastic. If you use the chart, the stock charts platform, you bring up a chart list, and up here you'll have an option to change how you view the list. You just want to pick candle glance. And by the way, this is a custom chart that I use for my candle glance visualization. If you use the default, you can actually change that. There's a gray message at the bottom. A couple steps you have to do, but it explains to you how you can actually set that up. Huge fan of that visualization, though, and I love using it. All right. I did see a question on small caps that I wanted to bring up. Here we go. Dave, is IWM chart pattern a big inverse head and shoulder pattern right now? Awesome question. We can go to the equity market indexes list because it's right here. Is this an inverse head and shoulders? I mean, I guess what you're thinking about is like this. I mean, maybe on a weekly chart, like this you're thinking. So no, I mean, I wouldn't call it an inverse head and shoulders. I guess, I probably would. I mean, I would call like this maybe an inverse head and shoulders back here, which was a low surrounded by higher lows, and you break the neckline. But as that was happening, I remember not thinking that was a great example of that. Because really the head and the two shoulders ideally are a little more even. They're a little more similar in size and duration. These are like two tiny shoulders and then one big head. Ideally, it's kind of a more symmetrical kind of classic pattern. So I don't know if I would call it that necessarily. Having said that, would it be incredibly meaningful for the IWM to finally break above its November 2024 high? Whether you want to label this an inverse head and shoulders pattern, maybe you're thinking this. I wouldn't call it inverse head and shoulders. I would say breaking above 240 and sustaining those gains would be incredibly meaningful, right? I mean, as the S&P and the NASDAQ have been making new all-time highs, the Russell 2000 has been well below its all-time highs. But areas of the markets that are bigger weights in the Russell 2000, things outside of the growth space, things like industrials and financials and things like that, regional banks are bigger weights in the Russell 2000. Those things continue to work. That's how small caps could start to actually outperform. That is something that has happened before. So we'll see if it finally can happen again. Folks, that'll do it for today. Thanks so much, as always, for tuning in. Those of you watching live and asking questions, I appreciate it. Keeps it interesting and awesome. Thank you for doing so. I didn't get to all the questions, but anything we didn't get to here and any questions on our YouTube channel, we'll put it in the mailbag, and we'll hope to answer your question on our mailbag episode. Next one will be this Friday. For now, I will say have a fantastic evening. Wish you much happiness and safety and joy wherever you're at. I'm Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts. Have a good night, folks.